Hello, and welcome to myfinancesteacher.org. Recently, I got a question from a member at myfinancesteacher.org on what might be happening to the US dollar and how far might it bounce over the next short term. So let's have a look at that. As you see from these black lines on the chart, I was actually expecting the US dollar to turn around and go back down after touching this 50-day moving average. Clearly I was wrong, so let's delete those black lines. Now, with the strength of this rally over the last week or so, I think there is a pretty good chance, I would say perhaps a 65% chance or more, that the intermediate cycle in dollar actually finished over here at the end of May, giving us a relatively short intermediate cycle lasting for 139 days. Usually these intermediate cycles in the US dollar last for around half a year. And quite often they actually last for longer than half a year. So while there is still perhaps a 30 to 35% chance that dollar just turns around from here and gives us a lower low with the final intermediate cycle low closer to the usual duration of just over half a year, I don't think this scenario is extremely likely. That's based on the bounce in the US dollar so late within the intermediate cycle of this scenario. Instead, we are likely to be in a new intermediate cycle on the US dollar, which means that we'll probably see dollar relatively strong for a while in the intermediate term, as the intermediate cycle is still relatively young at only 1 month old. But the short-term daily cycle, which usually lasts for only about a couple of months on the US dollar, is already approaching its midpoint. And as we see, the RSI on the US dollar is the highest that it's been since that March 2020 or February 2020 before the March drop. So we're already overbought on the US dollar. And as we see, US dollar has poked a few times above the Bollinger Bands. And if you only count the pokes above the relatively wide Bollinger Bands, the US dollar has already poked 2 or 3 times above relatively wide Bollinger Bands, and it's now above the 200-day moving average. So talking about the relatively short term, for the short term daily cycle, I think dollar is likely to trend upwards for perhaps another several days, maybe 1 week or so, before coming back down into the short-term daily cycle low, which will possibly happen in another several weeks, 4 to 5 to 6 weeks. And talking about the resistance zones above the current price levels on the DXY, we see a couple of factors coinciding at the resistance zone of around the 92.5. That's one of the previous highs in March this year. And also, if you throw in the Fibonacci retracement numbers on the intermediate cycle decline between late March and late May, this price level of around 92.5 again is close enough to that 79% Fibonacci retracement. By then, perhaps the dollar will be ready to dive back into the Bollinger Bands, at least retest the 200-day moving average, and later slide into the short-term daily cycle low. I would say this is probably the most likely scenario, and I would probably give it around 35% chance. So 35% chance that the dollar gives us a significantly lower low, meaning that the intermediate cycle is still ongoing since the beginning of this year. And the remaining 65% is split between this relatively more bullish scenario and another slightly more bullish scenario where the US dollar breaks above the nearest resistance zone and probably goes to the next resistance zone of the previous intermediate cycle high, perhaps somewhere around 93.5, before cooling off into the short-term daily cycle. So remember, nobody knows the future. And we're only looking at what's a most likely scenario based on a number of factors, which are what you actually see on the charts, including what other traders see, which creates these support resistance zones, and a range of other useful tools, such as, for example, seasonality, which personally I don't really find extremely useful. But since we're here, let's just have a look at it. What you might notice is that June and July usually is not really a particularly good month for the US dollar. That kind of agrees with our expectation of dollar perhaps cooling off sometime into the middle or second half of July. Another useful tool is, of course, the commitment of traders reports. Unfortunately, as you see over here, since the middle of last year, the interest in DXY has decreased quite a lot. The lines are flatlining a little bit closer to the zero line. And as opposed to the most recent period, if you look at the second half of 2018 through the 2019 and into the first half of 2020, you see that the green lines and the red lines make a little bit more distinguishable moves up and down. So what do we see on the COT reports right now is that this red line, the commitment of commercials, which are usually called the smart money, which usually declines into the tops. Looking at the last few weeks, we see that the red line hasn't really declined much into the ongoing top. Perhaps as a new report comes out, we'll see a tick down a little bit in this red line, but so far it looks like dollar has some momentum upwards, at least in the short term, based on what we see on the report so far. And of course, another extremely useful tool is market sentiment. Let's have a look at the market optimism index in relation to the US dollar. And while for the intermediate cycle, the ongoing optimism is still relatively low, the previous intermediate cycle topped when this optimism index on the US dollar was in mid-50s. Right now, the optimism index is at 49, but perhaps we are approaching hot enough levels for the short-term cycle, when the cool-off should start into the short-term daily cycle low, followed by another push into the intermediate cycle high, perhaps somewhere closer to the level of 60. So again, to summarize, what I see on this chart is perhaps strength over the next few days, cool off into the middle of second half of July, and another likely push into the intermediate cycle high. And lastly, whatever all these charts tell you, what might happen is that the Fed might actually ruin all your plans and all your scenarios. So let's have a look at what the Fed might say about the US dollar at the current market conditions. And as we were expecting over the last few weeks, the general stock market, this is the S&P 500, is actually declining, at least into the short-term daily cycle low. The ongoing cycle is now 37 days long. Usually these cycles last for around a couple of months, so perhaps we'll see a decline continuing for a week or a couple of weeks. And perhaps this will be a relatively strong decline into the intermediate cycle low, because the intermediate cycle so far is going on for 140 days. And usually these cycles last for around half a year on the general stock market, so it's possible we'll see a significant decline into the intermediate cycle low over the next few weeks. And of course, if such a scenario unfolds, what's likely to come out from the Fed is some dovish talk. Hence, in their attempt to support the general stock markets, perhaps the Fed is going to help to turn around the dollar back down, at least into the short-term daily cycle low. And that is when things like precious metals might finally get back into some sort of a bounce. How strong that bounce is going to be? Well, let's have a talk about that in some of the upcoming videos. Which means so far, that's all from me. And of course, now turning back to you, let me leave you with this question. Do you expect the DXY index anywhere below 90 over the next 3 to 4 weeks? Let me know what you think in the comments below. If you hit that like button, I would really appreciate that. And if you find the video useful, why not share it with your friends? Have a nice day and good luck in your trades.